Hello, this is Bill Moreland with Bankrate Data. Today we're going to take a look at a couple of banks to answer a question that I often get. Are banks well reserved? And my answer, annoyingly sometimes, is banks are reserved until they're not. So we're going to take a look at a couple of banks. There's nothing magical about these banks. They're just some institutions that I was looking at a little bit earlier in the week that prompted me to review the subject and spend a little bit more time talking about it. First bank we're going to take a look at is SouthPoint Bank in Birmingham, Alabama. It's publicly traded. I'm not going to get into all the metrics. All I'm going to do is basically walk through the scenario that I'm talking about here. There's a number of scenarios. There are banks that are well reserved. No doubt, you can definitively find it. There are banks that descend into being not well reserved. And then there's banks that are reserved until they're not. And when you look at a lot of banks, it becomes obvious. And the reason for this is it gets out of hand very quickly. So they look like they're well reserved. And then the next quarter, they're not as well reserved because their NPLs are going up. And then the very next quarter, they're not reserved at all. And then you start to see what they have to do. And it means they're going to have issues with income as they have to start setting aside more provision. So SouthPoint Bank is the first one we're going to take a look at. It's a $1.8 billion bank in Birmingham, Alabama. Once again, this is not a full out review, but we're going to come into loans 2012. We're going to see some very quick loan growth, which is another saying that I often have, which is fast loan growth can be problematic. We look at delinquencies here. We look at whether they're restructuring, and we pop down here and we can see what portfolios are being problematic. And so we can see that that's the 90 days past due plus non-accrual. If I come in and looking at non-performing loans, you see a bunch of growth in loans, and you're going to see a couple of quarters to a year or two later, a bunch of growth in delinquencies. It's not always the case, but if you put fast-growing banks and portfolios, you put all those guys in a bucket, a lot of those guys are going to be okay, but that bucket's still going to have a higher preponderance of this pattern where you see non-performing loans start to go up. So we're going to take a look at and this is across the board for this bank. I mean, we can see it's C&I, we can see it's 1 to 4 family, we can see they're having problems with owner occupied, and there's just a brand new one. We can see that they're having problems in construction, and they're kind of working through that. Home equity loans, it's just portfolio after portfolio. And this also is indicative of something that I'm seeing. I'm not trying to be the Pied Piper of doom, but this is not strictly a commercial real estate issue. This is not strictly a consumer issue. We have multiple portfolios across the entire industry are having problems. And SouthPoint is indicative of this. So I'm going to go to asset quality. I'm going to take a look at aggregate non-performing, because what I see is how many of these are going to be guaranteed. I doubt many, but let's just take a look. There's the aggregate non-performing. We see a jump up, and then we see another jump up to 22, and then we see a big jump to 39 million. Do they have any guarantees? $342,000. So this is adjusted NPLs, and we can see the ratio has gone from 49 basis points to 1.16 to 2.54. A lot of people spend time looking at this ratio, which is allowance to total loans. It's not one that I spend a lot of time looking at. There are variations you can back out. That's typically the ratio most to look at. I tend to not look at this. I tend to spend a lot more time recommending coverage ratio. And the way to look at this is how many dollars of reserves do they have for every dollar of adjusted NPLs? And right now they're sitting at 83 cents, which is not horrendous. There are plenty of banks that are sitting at 40 or 30 or 50. But you can just go back a year and a half ago, and they had $2, $2.83, and $1.96. I mean, they're sitting at 12, 13, and $15 million of reserves, of allowance, against 6, 5, and 7. So they were sitting at $2 to $3 of reserves. And this is, you could sit there and say, they're well reserved. Are they well reserved? So people will come in and they'll look at this ratio and they'll say, 110, 116 basis points. a little bit behind. They'll look at the coverage ratio, say $2 to $3, not too bad. But then they're not. And what I mean by that is you see that big jump up right there from 7.6 million to 17.2. And then they cruise along okay, and then it increases again, and then we see a significant increase. But note here, the allowance basically goes down from 19.2 to 18.9. This probably took some charge-offs, right? And then you see a huge increase in allowance. So this bank right here was becoming very much not reserved. And if I come down and I look at the bottom of this, which is all the other banks their size, we can see that they're, 87 basis points get you into that 90, the bottom 10%, right? And so what happened is they obviously had to, if we see the allowance go up, they had an enormous increase in provision. And that's basically going to affect their ability to generate income. Was this predictable? Yeah, it was predictable. Because you could sit here and look at the non-performing loans are going up and up and up. And they're trying, to their credit, they're basically, they are setting aside more reserves. Every quarter, that number's climbing. The problem is their delinquencies are climbing at a much higher ratio. So if you were sitting there and you're saying, are they reserved? I said, no, they're not reserved. Because we basically see that their delinquencies are climbing. Well, what does that mean? Well, look, man, I don't know on SouthPoint, but if I take everybody that has that pattern where they look reserved, fast growth, delinquencies are climbing, they're trying to set aside reserves, and I put those banks in a bucket, there's a really good chance the delinquencies are going to get worse. You're going to see they're going to have to allocate more for provision. Did they take charge-offs? Yeah, they've been taking a couple of charge-offs, right? So you can see that pattern. So publicly traded bank, it was predictable that they're probably going to have some issues. They're going to have to set aside some money in provision, and it's going to affect income. So SouthPoint is by no means the most extreme example, but you could see that slow descent into becoming less and less reserved. Let's take a look at Middlefield Banking Company. Once again, there's nothing magical. It's a publicly traded bank, same range, $1.8, $2 billion in assets. Looks like they had an acquisition a couple years ago. I don't know if this is an acquired portfolio or whatever. Don't care. Question is are they reserved? All right, so let's start working through this once again. So we do see some loan growth, but we don't know how much of that, right, was acquisition based. Since the acquisition, they are growing. We come down, we look at delinquencies. We can see that their delinquencies are starting to climb. Are they restructuring? Yeah, they've got some restructured debt. Come down here, or loan modified loans. How many portfolios? Well, let's start cycling through. There's 6% non-performing loan rate on 1 to 4. So this looks like, non-owner occupied. So this looks like part of their portfolio, part acquired portfolio. Looks like they brought about $100 million on in the acquisition. And there you have it. A couple years ago, they were sitting at 128. Then it went to 2%. Then it went to 3. Now it's upwards of 6. Are they having issues in other portfolios? There's owner occupied, starting to roll over a little bit. Home equity loans, starting to roll over a little bit. Construction 1 to 4, starting to. So these are two separate banks, two separate parts of the economy, the country, and you're seeing the same pattern. You're almost seeing the exact same portfolios, right? Where, and this is not, I didn't go look for these. This was a call I took on Monday, and this was a call I took on Tuesday. So let's go look at reserves. Go to asset quality. Go take a look at allowance. That's the figure that a lot of people will look at. 1.5, 1.45, 1.48. Once again, I don't like that ratio that much. I like to look at this ratio. Go back a couple years ago, same thing. 2 to 3. $2 to $3 for every dollar reserves. But what you're seeing is that their delinquencies are climbing, climbing, climbing. So when you get to this point right here, is this pattern just going to stop, right? At some point they will. At some point delinquencies will stop continuing to go up and up and up. But in this particular bank, it's not, right? You're starting to see those delinquencies. I call these ripples in the pond. We're getting a lot more ripples in the pond. We're seeing aggregate delinquencies go up, but they're heavily driven by the biggest banks. But as we get deeper into this cycle, this credit cycle, what's happening is it moves down the asset size food chain. And these are good sized community banks, but they're less than 2 billion, right? They're not big, massive banks. But we can see this bank is starting to have problems. They're not as reserved. Where's their 75 cents per dollar? Scroll to the bottom. They're in the bottom 5%. So these banks are not reserved. If we add in the loan modifications they're doing, you can see we kind of had some hints, right? We had some hints. So this just didn't happen. Let's go back. Loans 2012. Look at loan mods. Look at this. So they were basically restructuring debt going back 2 years ago. I don't know if this was acquisition, after acquisition, but look what they did. They did not put them on non-accrual. So these were loans that were stressed. They probably knew they were paying in and out of delinquency intra-quarter. At that time, we weren't seeing it. So look at this. This is fascinating. This is not, can you predict this? Yeah, you can. I mean, sometimes you can't. It just comes out of the blue and smacks you. But here on the left, we're looking at non-performing loans as recognized. Here on the right, we can see that they were restructuring loans a full year and a half before we started to see the delinquencies come through. Performing means the loan was modified, but they left it off non-accrual. And they do that because they don't want it to show up on non-performing, because non-performing is 90 days past due, accruing interest, and non-accrual. So what they did here is they were kind of trying to keep this off, basically off non-performing loans. And so now the question becomes is, well, what happened? How did it go down? How do you go off of non-performing loans? They went delinquent again. That's it, clear as day. So this is extend and pretend 101. And we can look, we can come down here. Are they doing it across the board? So where were they doing these where were they restructuring these? And we'll just cycle through. Right there. All of it is non-owner occupied, right? Almost the full dollar amount. So they were starting to have commercial real estate problems. They restructured them. And then did they have anything else in any other portfolios? No, but now they're starting to do this in multifamily. Granted, it's small. So this is all non-performing, non-owner occupied. So they restructured it to keep it out of delinquency. And that worked for a little bit of time. But then you're now seeing those loans recidivate back. Now, could this be a whole separate group of loans? Yeah, entirely possible. But that's even more problematic, right? Because chances are what they're doing here, did they take any charge-offs? Yeah, they took a charge-off there. So part of it could be that. I think what's probably happening here is they're modifying these loans, keeping them off non-accrual so they don't show up as non-performing. It's working for a little while, and then it doesn't work. And when it doesn't work, they go back into delinquency. 17 to 2 is about 15 million. There's about 15 million right there, plus that little charge off. So once again, it's not a criticism of Middlefield Banking Company, not a criticism of Southern Bank. But as you look at these banks, you can kind of predict what's going on. Granted, not every bank that has that spike is going to immediately have more delinquencies come in. But right now, we're in a window where I'm seeing more and more of this. And I don't want to be pessimistic, but I just don't see, until we start to see less banks having these problems and the bigger banks start to come down on their delinquencies, right now we just have to assume the delinquencies are going to continue to get worse, and you're going to basically look at more and more banks that are going to look reserved, and then they're progressively going to get worse and worse to the point where they're not. As always, I appreciate your time. If you have any questions, feel free to give me a call. Thank you.